Next to present, I am pleased to introduce Andy Grossman, Executive Vice President of Capital Markets and Head of Investor Relations at Green Thumb Industries. Green Thumb Industries is one of the largest vertically integrated multi-state operators in the nation, as it is licensed and generating revenue from 12 US state markets. Green Thumb has 13 manufacturing facilities across the nation that produce and distribute its cannabis consumer products under its own suite of brands. Those include Bebo, Dog Walkers, Dr. Solomon's, The Incredibles, Rhythm, and the Field Collection. The company also possesses one of the largest retailer networks in the country, with 48 dispensaries open today, which operate under the Rise and Essence dispensary store banners. Green Thumb continues to be an Echelon top pick in the cannabis sector, having been assigned that designation over a year ago now. And we believe the company holds a winning strategy coupled with operational excellence and intelligent capital management practices. With that, I would like to turn the call over to Andy, who will tell us more on Green Thumb and the opportunities ahead. Over to you, Andy.
Thanks, Andrew, and thank you, Echelon, for hosting this cannabis conference. There's a lot of exciting things happening in the cannabis space and lots of catalysts upcoming in the fall, so good timing on your part. But first, I think it's important for people to understand the US cannabis market opportunity, big picture, and then understand what Green Thumb is, what we're doing, what our strategy is. Our strategy of building a consumer products portfolio plus a retail experience, our community impact, and then finally financial performance. So, opportunities in the cannabis industry, the industry is expected to be an $80 billion industry. So that's on par with wine and spirits. It's a little smaller than beer and tobacco, but this is a massive CPG industry that's being formed in front of our eyes. And we're expecting to see 20% growth a year for the next 10 years. Wine, spirits, tobacco, and beer companies, they see single-digit growth. They look at the cannabis industry and they're drooling at what's happening in the US cannabis space with 20% growth. And, prohibition the first time, what caused prohibition to end is the same thing that's going to cause prohibition to end the second time here with cannabis. And that's, regulatory momentum, positive social momentum for change throughout the country. It started with legalization in Canada. We also passed the bill for hemp in the US to legalize hemp, and we think there's going to be more changes along the way. One of the benefits to cannabis being legalized in these states is that opioids deaths have decreased by more than 25% in states that have legalized cannabis. So very good reason why you're seeing a trend towards legalization, throughout the country. So, this slide is a slide that we've had in our deck since we went public in 2018. But today, the US cannabis market is about a $15 billion market, and the market cap for the publicly traded companies is about 15 billion. So 1 times current market, but the expected market is 80 billion. So it's a fraction of that TAM. Where in Canada, where it used to be that the Canadian LPs were a $50 billion market cap, they've come back down and now are around the same market cap as the US MSOs, about 15 billion, but their opportunity in Canada is much smaller. They trade at a multiple of TAM, and the US operators trade at a fraction of TAM. So plenty of opportunity for many of the companies that you heard today to continue to grow and build market share throughout the country. Look, we're looking to become the national leader in cannabis, through consumer products in the United States, and we're going to do that by promoting well-being through the power of cannabis. With trusted consumer brands, accessible retail, a people-first approach, and forward thinking to investing. So this is Green Thumb at a glance. The business was founded in 2014. We have over 1,900 employees. Today, we have 6 brands in our branded CPG portfolio. We think of it as having a house of brands approach, where we have lots of different brands for different demographics, and we distribute those brands to all the stores in the states which we operate in addition to our own stores. And so now that we talk about our own stores, we have 48 stores open today throughout the country. So we're creating a national cannabis retailer throughout the country with 48 stores open and the ability to open up 96 stores throughout the country. And as you can see on the far right, the business has grown a lot. Revenues have tripled every year since the business was started. We did a little over 216 million of revenues in 2019. And law of large numbers, that won't continue to grow going forward at 3x, but will grow a lot higher than the 20% the industry is slated to grow over the next 10 years. So it sets up for really good opportunity for us at Green Thumb. And so what we're looking to do is create a vertically integrated supply chain. And the reason why that's important is because that ensures consistency in the brand experience from market to market. It's not easy building a cannabis company in 12 different states. You effectively have to have 12 different businesses set up. Think of it as 12 different countries where, Canada is one state within. Setting up these operations is very difficult, but we've done a good job at building the platform so that we can distribute brands at scale throughout the country. We have 13 cultivation and manufacturing facilities open throughout the country. And then we distribute not only to the other retailers, but to, like I said earlier, our retail stores called Rise and Essence throughout the country. So our strategy and execution is really simple: enter, open, scale. So the first couple years of the business, it was entering new markets, applying for licenses. So there's 2 ways to enter a market. You apply for a license, or you can do M&A transactions. We've been very successful at doing both. We've won over 30 competitive license processes to win licenses in these limited license states that we go into. And then we've also been really successful at doing M&A. We've announced several large deals. We've closed those deals, integrated those deals on time, on the announced terms, with no change in price along the way. And then getting open is very difficult. But like I said on the slide before, building a business, a consistent CPG business throughout the country is very difficult. But we have done a good job of getting the operations open, whether it's for our production facilities or our new stores throughout the country. We've been able to do that over the last couple of years. And then finally, scaling the business is the most important. And that's where we are today as we look to scale in some of the limited license states throughout our portfolio. What that will do, it will help put us in a position for sustainable and profitable growth going forward. So here's a map of where we are in the country. The green are states that are currently medical markets, and the orange is adult use markets that we're operating in. I'll highlight 2 markets for you: the Pennsylvania and Illinois markets. For those of you that are not aware, Illinois legalized for adult use on January 1st of this year. And it's already doing a run rate of all over $1 billion. So the end of last year, Illinois was a 25, was roughly doing about 25 million a month in revenues at retail. And July they did over 94 million of revenues. So run rate of $1 billion. We expect that market to be at least a $3 billion market. And we think 3 billion is very conservative, because in the first 7 months of the program, 20 to 25% of the purchasing was done from people out of state. So when you account for out of state, we think 3 billion is definitely conservative. So as we invest into the Illinois market that is extremely supply constrained, it's really beneficial for our business. And so it's very different from what's happening in Canada, where you have unlimited competition. massive, supply. And you're seeing companies close facilities, sell facilities, and shut down these large operations that they thought they were going to need. Where here in Illinois, there's only 20 licenses that, where the operators can produce product and sell product in the state, and it's massively supply constrained. Same thing's going on in Pennsylvania, where we also have a dominant position. In the Illinois market, we have 8 stores open. We have the ability to open up another 2 stores. In Pennsylvania, we have 12 stores open, with another 6 to potentially open down the road. And so, we're excited about both markets. Pennsylvania is a very fast-growing medical market. The reason why it's so fast-growing is because the list of qualifying conditions were pretty easy for people to get access. Initially, chronic pain was on the list of qualifying conditions. Then they added anxiety to the list. We know that everyone's anxious in this COVID period, so that's why you're seeing a big increase in patient count in that market. But still, less than 2% of the population has been, penetrated. And so we look at everything based on market size, what we think the market ultimately will become, what the current penetration rates are, how many licenses are in the state, and then we try to optimize our allocation of capital into the most inflective markets throughout the business. And so, we believe we're building a consumer packaged goods business, a portfolio of trusted consumer brands where we own these brands. These are our brands that we're building. And the hope is that the platform we've created is very valuable, but the brands that we are manufacturing to distribute on our platform ultimately will be the real value generation for our shareholders going forward. And you can see we have products that, flower, vape, edibles, topicals, but where we focus, it's very data driven. We focus on the highest growth sectors. And you can see in the pie in the middle, this is based on last year's data, but pre-rolled joints grew at 44%. Edibles grew at 24% and vape grew at 24%, with flower only growing at 7%. Everyone loves flower, but that is, roughly 50% of the pie. And we think that's going to go down over time, and the focus will be on CPG products going forward. And so that's really what we're focused on today, and making sure when we, build products, we do it in a way where it's in the category that's growing the most. And so here's a look at, the family of brands that we have: Rhythm, Incredibles, Bebo, Dr. Solomon's, Dog Walkers, and the Feel Collection. All for different types of people. We are looking to promote well-being across different consumer segments. A lot of times people come in our stores because they want help with sleep and pain. So it's all about promoting well-being. People want to be comfortable, healthy, and happy. And we believe, we have different products for those uses, and, people, are really liking what we're building, and our brands are really resonating with them. So this is just an example of one of our brands. It's called Rhythm. It's all about finding your rhythm again and again. We make, it comes with flower, vape, concentrates. One of the strains in the line of flower is called Brownie Scout. We can't grow it fast enough. It flies off the shelf. It tested over 38% THC. So, getting a lot of, positive feedback, and seeing a lot of positive feedback online from people as well. Dog Walkers is another brand that we're building. Pre-roll joint brand. Usually, you smoke a pre-roll joint with a group of people and it's a full gram. Too much for a single session. Well, Dog Walkers comes in a mini tin, like an Altoid tin, and it's enough just for the dog walk. It's 0.35 grams. Everyone loves their dogs, and part of the proceeds from the sale of Dog Walkers goes to animal shelters throughout the country to help save dogs' lives. So excited about that brand. And then just one last brand I'll talk about is Incredibles, the Credible edible. Chocolate bars and gummies and tarts are what we manufacture, and we think this is going to be the leader in the edible category throughout the country. So very excited about the rebranding that we just did, of this brand. The brand has been out there since 2010, started in Colorado, and now that we own it, and we're going to bring it onto our platform throughout the country. So very excited about that. So as I mentioned, we have 48 stores open today. Last year in 2019, we said we'd open 15 to 20 stores. We opened 20 stores, so at the top end of the guidance from last year. This year, we didn't give guidance for new store openings because of COVID, but we did open 9 stores year to date, and 7 of which we've opened since COVID. So the retail team has been active. Same store sales are north of 75% in our stores. And so, on a year over year basis, there's a 16 store comp base. Quarter over quarter, same store sales were up 8% on 40 stores. And the reason why we're able to show that growth is because the penetration rates are so low in these limited license states that we've barely begun to scratch the surface. This is very beginning innings in this new industry as it's being formed. And so on the retail side, how do we win in retail? We believe we're going to win with great service and selection. People feel like when they come into our store, it's like a family, and they love the selection that we have in our stores. Typically, we keep 30 to 40% of the shelf space, our brands, and then the balance is everyone else's brands who manufacture in the state where we have a license. And so having great selection for the consumer is very important. I mentioned, we have over 1,900 employees. That's grown by 10x over the last 2 years. And so building out the team is very important, and making sure that we have alignment of interest with the team. And so we make sure that a lot of the team members have equity in the business. Management owns about 20% of the business, so there's alignment there. When we do deals, we want to make sure there's alignment as well. And so we like to do deals with large stock components so that people want to come in and continue to work and build this business together with us, going forward. And then it's also important to make an impact on the local communities that we're serving. And so we have continually, given time to different community projects to help give back to others. And then finally, in Illinois, they're in the process of giving out additional licenses for social equity licenses. And so we had a LEAP program, which helped people on a pro bono basis write their applications to win. And then the next step is, once they get their licenses, to work with them and incubate them to help make them successful and make the program successful going forward. I'll touch on this a little bit now. We think that's the trend going forward. We talk about the catalysts. We talk about what are the catalysts going forward. We believe that the trend going forward is these limited license states that have started out as medical programs they're all watching Illinois. Illinois generated over $66 million of tax revenue in the first 7 months of the program. And other states are watching it very closely and saying, I want the same thing in my state. I need it for my state budget. I need the jobs in my state. Just today, the governor of Pennsylvania urged legislators in his state to legalize cannabis this year in Pennsylvania. New Jersey, it's on the ballot. New York is we assume New York and Connecticut will shortly follow thereafter. And so you're going to see lots of states transition from medical programs to adult use programs to capture that tax revenue going forward. And so even without regulatory change from a federal perspective, we think you'll see regulatory change on a state-by-state basis. I'll go quickly on the next couple of slides because I know we want to allow time for questions. But as I said, I won't go through individual members of the team. The team is how we win. We have over 1,900 employees, but the team is the most important part of what we're doing. Without a great team, we can't win. And we've been really successful at hiring from other major CPG businesses to help, bring their knowledge from other successful companies to our company to help build it, going forward. And in addition to our team, our board is also part of our team, and they've been there to help guide us, going forward, whether it's on branding, real estate, community, governance, et cetera. It's been, very important for them. And I also think our shareholders have been part of our team as well. We are aligned with our shareholders, as I said, and they've been big supporters of what we're doing. So I'll go real quickly on our Q2 numbers. I think Q1 was the point of inflection for the business. It was the first quarter where we reported over 100 million of revenues. Q2, we reported about 120 million of revenues. And we were able to achieve about 30% EBITDA margin. So adjusted EBITDA was over 35 million and ended the quarter with over 82 million of cash on the balance sheet. And so you can see on the right-hand side that the growth is pretty tremendous in this business. And we are very excited about what's to come. What you don't see is the benefit of the CapEx that we've spent over the last 6 months. So we've spent about 75 million of CapEx, in the first half of the year. We're not slowing down. We'll continue to spend, going forward into the end of the year, into next year. But you'll start to see the benefit of that in Q4 of this year and Q1 as some of the large scale cultivation projects come online in places like Illinois and Pennsylvania, where we've effectively doubled our capacity as the growth has been, inflecting going forward. Just one last thing on this slide, we have about 100 million of debt outstanding. And then, 210 million shares outstanding, very clean structure here. We have over 70% of the shares in the float. We think this is very differentiated from our peers. As we went public, we've been distributing our stock to legacy holders. And unfortunately, we've put the stock into good hands of people who want to own this business for the next 3 to 5 years. So the stock trades about 500,000 shares a day with over 70% in the float. That just tells you that, we put it in the right hands of people who want to own it over the long term. So I'll stop there. I know I went a couple minutes over, Andrew. I apologize, but let you go through a couple questions from there.
That's great. And I would I'd just remind our viewers that you're able to ask a question through the Zoom platform, Q&A function, through YouTube, and by emailing myself directly. So Andy, I'll kick us off here with the first one for you. I just want to touch on your enter, open, scale strategy, and I appreciate your comments on it. It is a strategy. It's a strategy we've called a winning one in the space. We've seen some of your peers gravitate more towards your strategy there by consolidating, becoming more focused in certain markets. But it's also a strategy where you need to rebuild that enter phase. You need to rebuild that pipeline for the next phase of growth. So I'm wondering how you're thinking about building that next phase and making sure you've got a robust pipeline of opportunities to enter into.
Yeah, so look, bottom line is we have a robust pipeline inside the portfolio that we have today in the 12 states. When you think about all the major cities throughout the country, whether it's Las Vegas, Boston, Cleveland, Pittsburgh, Chicago, Philly, LA, we are in all the major markets throughout the country. Andrew, if you asked me the question 2 years ago, I would have told you we have a lot of work to do. But I think we've filled out the portfolio nicely to be able to distribute brands at scale throughout the country. But that doesn't mean we're going to stop there. We'll continue to look at M&A transactions to enter other states. But even if we don't do any M&A transactions, there's just massive growth within the portfolio that we have today, given how low the penetration rates are in these limited license states. So we'll continue to grow both, inside the business, and then we'll look to M&A also to add other states down the road. But the most important thing is to make sure that the business is generating cash. And so Green Thumb has generated cash after tax, which is important, after tax, in the first 2 quarters of this year. And so what that does is it allows us to continue to build the business going forward, invest the cash back into the business to allow for more growth going forward. And that's where the growth is going to come, over the short period of time, assuming no M&A or no additional license wins. Just because, we haven't done any M&A recently, that doesn't mean we won't do any M&A, going forward. It's still real early, but we're more focused on making sure we don't tip over, we don't inherit someone else's problem, and we have a business with the best fundamentals. That's the most important. It's not about becoming the biggest. Some people like to say we want to be the largest cannabis company. I want to have the best business with the best fundamentals. To us, that's the most important thing, and I think the investors will reward us for that going forward.
Thank you for your comments there, Andy. I just want to focus on one market now, Illinois. We've seen that gone from a $300 million run rate to $1 billion now, and your thoughts that it could get to $3 billion in the not too distant future. What steps is GTI going to have to take to support that market growth? And how is GTI's position in that market going to look like several years down the road as that approaches maturity?
Yeah, so the hope is that we will continue to be a dominant player in that market for the balance of this of the game that we're playing. But what have we done? So when legalization was announced about a year and a half ago, we allocated more of the capital that we were going to put in other places into Illinois because we knew we had our first mover advantage that we needed to protect. And then this past March, we announced a $50 million sale leaseback transaction. We have 2 cultivation and processing licenses. And so on the second location, we will be expanding and have been expanding over the last 5 months and continue to grow there. But what that will do is allow for us to bring additional supply into the market that is massively supply constrained.
That's great. And just want to pick up a question from the audience here.
Great.
It might add a little bit to it. Just asking on, you operate in a number of states, 12 state markets now. And I know you'd already mentioned you're continuing to build out your presence in existing markets. But what's your thoughts about, doubling down on the markets you already operate, or do you think adding new state markets to your portfolio is an accretive activity at this point in time?
So we don't have unlimited capital. And so we need to be careful about how we allocate capital and where we allocate it. And so when we look at M&A transactions and we look at allocating capital into our business, the question always becomes, what's the return on invested capital for our shareholders? And so over the last 6 months, the greatest return on invested capital for our shareholders was to invest more of our CapEx dollars into places like Illinois, Pennsylvania, and Ohio, where we spent about $100 million of CapEx dollars, to build cultivation and processing facilities in those locations. So to us, that's the key. It's not a question of one or the other. It's okay, well, what's the return on invested capital for shareholders? And for as long as we have this opportunity where it's that much greater to deploy capital inside our business, then we'll deploy capital inside our business. And as that evaporates, we'll go to M&A transactions and other places in the portfolio. But capital's scarce in the industry, and we don't have unlimited capital, so we need to be really prudent with the balance sheet here. We've seen everybody's get into trouble, and we don't want to be one of them.
That's very helpful for our thinking on the business here. And I think we're just bumping up against our time constraint now, but Andy, we'd like to extend you a warm thank you for joining us today. And we appreciate the insights you were able to share with us.
Yeah, thanks so much for having me. I appreciate it.